Sometimes I look at this and feel I'm just some guy who doesn't really know what he's doing. That line isn't humility, it's a system of thought. It's the operating belief of someone who refuses to trust intuition and refuses to pretend he understands a complex domain better than the data does. That's the mindset that builds a machine like Renaissance. He advances because he assumes he doesn't know, and that assumption forces continuous discovery, continuous adjustment, continuous rebuilding. The sentence is not weakness, it is discipline. Early in Jim Simon's life, you already see the core pattern. He isn't chasing recognition, prestige, or the approval of authority. He's chasing hard problems. He isn't driven by academic hierarchy or by the desire to impress colleagues. He is driven by the internal need to expose hidden structure. That psychological trait, the compulsion to pull signal out of noise, is the seed of everything he builds later: the math career, the code breaking, the Stony Brook department, the trading models, the Renaissance culture. When he doesn't understand something, he doesn't avoid it. He locks onto it. His obsession keeps him in the domain long enough for complexity to yield. His work in pure mathematics looks like a theoretical pursuit, but it's actually training for the life he's going to build. Learning to tolerate chaos, to sit inside ambiguity, to work on problems that don't reward brute force, but reward patience and structural thinking. Chern-Simons isn't just a mathematical result, it's an exercise in modeling complexity without emotional frustration. That skill becomes the foundation of Renaissance. Nothing about the markets rewards impatience. But IDA, the Institute for Defense Analyses, is the real prototype of Renaissance. This is where he internalizes the idea that defines his entire financial career. A pattern does not need an explanation to be useful. If a signal predicts, you exploit it. If the model says yes, you execute. You don't wait for a narrative justification. You don't need a theory of causation. You don't need to feel smart. You trust the empirical structure. That runs completely counter to the culture of finance where most people want a story to make themselves feel comfortable with the trade. IDA destroys that requirement. He learns to operate without narrative. He also sees something most leaders never learn. Surrounding yourself with brilliant people means surrounding yourself with difficult people. The sharpest code breakers were volatile, eccentric, emotionally unstable, but they produced results. Simons doesn't romanticize their brilliance, but he respects it enough to tolerate the chaos. He records that equation. Later, that becomes the cultural backbone of Renaissance. Hire people who can see what you can't, even if they don't fit anywhere else. When IDA fires him for criticizing the Vietnam War, his reaction tells you everything about how he handles institutions. He doesn't collapse. He doesn't cling to security. Authority is not a structure he obeys. It's a structure he bypasses. That psychological independence is what allows him to enter Wall Street without reverence. He never accepts that finance works the way financiers say it works. To him, those rules are hypotheses waiting to be disproven by the data. At Stony Brook, he builds something just as important as any model. He builds an environment where intelligence operates without friction. He doesn't recruit based on polish or status. He recruits based on raw cognitive power. The department becomes a magnet for minds that would break in normal academic hierarchies. And from this, he learns a leadership principle most founders never understand. If you want breakthroughs, you can't optimize for harmony. You optimize for insight. Then the shift happens. He starts paying attention to markets. But the motivation isn't money. It's pattern recognition. When his first small investment works, he doesn't interpret it as profit. He interprets it as signal. Something is there. Some structure. Some repeatable anomaly that should not exist if markets are as efficient as finance professors claim. The idea hooks him. The idea is the next puzzle. When he opens Monometrics, the operation is tiny, almost laughable, but the architecture of thought is already formed. Bring in brilliant people, ignore Wall Street's assumptions, build a system that continues working even if you, the founder, don't understand every detail. That is Simon's signature move. Build a machine that doesn't depend on your personal intuition. The first models Baum builds are clumsy, but they reveal a critical truth. If a mediocre model finds something, a great model will find much more. Baum proves the solvability of the problem. Acts contribute stronger ideas, but with enormous interpersonal cost. This is where Simons makes one of the foundational leadership decisions of his life. He tolerates the chaos only to the point where it still serves the machine. He does not let genius destroy the mission. That's not philosophy. That's operational discipline. Strauss enters and establishes another pillar. The model is only as good as the data beneath it. While the rest of Wall Street is trading with incomplete, messy data, Strauss is building a clean pipeline. He's rewriting history tick by tick. And this becomes Renaissance's hidden edge. They are not just a modeling firm, they are an infrastructure firm. And in the long run, infrastructure compounds far faster than intuition. Then Brown and Mercer arrive. This is the breakthrough that no one else in finance can replicate. They don't think like traders. They think like people who build systems that decode language. Price is a sentence. Markets are paragraphs. The world is a stream of probabilistic signals. And that domain transfer, using tools designed for linguistic prediction, is the fundamental reason Renaissance ends up decades ahead of everyone else. Their first equities model fails badly, and here the core Simons pattern reappears. He does not protect pride. He does not defend bad ideas. He does not hide from failure. He sets a constraint. Fix this soon, or we shut it down. Not because of panic, but because a broken system creates cognitive debt. It distracts the organization. It consumes bandwidth. It slows the machine. Then Magerman finds the bug, and that moment is not about the bug, it's about the culture Simons created, where a younger programmer is allowed to challenge the architects of the system without being crushed by hierarchy. That's how systems improve, not through seniority, but through accuracy. And when the system begins to work, Simon sees exactly what it means. The market contains structure. Not a lot, but enough. And if there is even a small amount of exploitable pattern, he knows exactly what to do next. Scale the discovery, reinforce it, and build a self-correcting machine that adapts faster than the humans running it. Once the equities model stops failing and starts producing stable signals, the psychological center of Renaissance shifts. Before this point, the firm is in survival mode, long stretches of confusion, bursts of optimism that collapse within days, weeks, where nobody knows if the company is even going to exist in 6 months. But when the machine finally shows consistent predictive power, the culture changes. Not into confidence. Simons never allows confidence, but into something far more operationally useful, inevitability. The team begins to feel that the problem is solvable, not solved, solvable. And that difference fuels
is
the
that
next
human
decade.
intuition starts losing authority. For years, researchers had a kind of psychological fallback. If the model didn't make sense, they'd lean on gut. But now the system begins outperforming everyone's instincts. Signals they would have rejected a year earlier are suddenly profitable. And because Renaissance is a place where empirical truth outranks ego, the culture begins to invert. The machine becomes the authority. If the model contradicts your intuition, the model wins, every single time. Most firms say they do this. Renaissance actually does it. This is the first real moat. Everyone can build a model. Almost nobody can build a culture where nobody is allowed to override it. That discipline is what separates Renaissance from every quantitative firm that tries to copy them in the years ahead. The next shift is the explosion of data. The team realizes that the more data they feed the machine, the more precise the predictions become. It isn't obvious at first. Most investors assume too much data is noise. But Renaissance learns something counterintuitive. Noise becomes signal at scale. Weak predictors, individually meaningless, become extremely powerful when combined in the right mathematical structure. This is the lesson of code breaking, of language modeling, of every domain Renaissance's people came from, but no one in finance was applying it at this level. Strauss becomes the silent engine of this transformation. He obsessively cleans data no one else even thinks to verify. He checks timestamps, rebuilds missing history, corrects corporate actions by hand, reconstructs trade sequences the way a forensic scientist reconstructs a crime scene. The consequence is that Renaissance's models are operating on a cleaner, more complete version of reality than any competitor. Other funds think they're competing on models. In reality, they're competing on data quality. Renaissance has weaponized accuracy. As the firm expands into more markets, commodities, currencies, international equities, something even more important happens. The models become smoother, correlations decay, drawdowns shrink, market-specific noise is cancelled out by cross-market structure. This is the moment Renaissance transitions from good quant shop to statistical organism. The machine is no longer a set of models, it's a constantly adapting, self-correcting meta-model that updates itself based on shifting global micro-patterns. Simons describes it almost like something alive, and he isn't wrong. The system evolves daily. Inside the firm, human behavior becomes more chaotic, not less, and this is important. Most organizations stabilize when they succeed. Instead, Renaissance becomes more eccentric. You have researchers fighting over trivial issues, brilliant people overreacting to small irritations, arguments erupting over details no outsider would understand. But Simons doesn't try to iron this out. He's already learned, at IDA, at Stony Brook, that brilliant people don't become compliant just because you want them to. You don't domesticate genius, you channel it. So he manages the environment, not the personalities. He keeps enough structure to prevent implosion, but enough freedom to allow breakthroughs. It's not pretty, it's not corporate, but it works. Once the machine starts producing returns, the outside world begins reacting, and almost all of it is wrong. Competitors assume Renaissance has discovered some elegant master insight. They search for a single principle, a unified philosophy, a theory. They're projecting their own mental models onto something that doesn't share them. Renaissance doesn't have an elegant secret. It has thousands of ugly, tiny, independent edges that combine into something overwhelming. The firm's power is the aggregation. Wall Street doesn't believe in aggregation. It believes in conviction. That's why nobody can replicate Medallion. As profits grow, so does paranoia. This is one of the least understood aspects of Renaissance. People think a winning system becomes easier to run. It becomes harder. Success sets a baseline that feels impossible to maintain. Every day, the machine is expected to extract predictive structure from markets that shouldn't have any, and everyone knows the edge is fragile. The firm's culture doubles down on skepticism. Every signal is questioned. Every line of code is suspect. Every improvement is temporary. They do not let success create faith. Faith is the enemy. Faith creates blindness. They operate under the principle that the model is always one step away from breaking. This paranoia proves itself during the 1998 market crisis. Long-term capital management implodes because their models assume a world that will follow their theory. Renaissance thrives because their models assume nothing. LTCM trusted explanation. Renaissance trusted correlation. LTCM expected convergence. Renaissance expected variance. The difference in worldviews produces the difference in outcomes. LTCM loses billions. Renaissance makes money in an environment where almost everyone else bleeds out. This becomes a defining moment. It confirms that running a model you don't fully understand, but that empirically works, is safer than running a model you understand but can't adapt. As Medallion's returns stack up, something counterintuitive happens to Simons. He becomes less central. The firm no longer needs him to guide technical direction. Brown and Mercer build systems far more complex than anything he constructed. Laufer pulls insights from the data structures that even Simons has trouble grasping. New researchers arrive with fresh mathematical tools. And instead of resisting this, like most founders do, he leans into it. He transitions from engine to stabilizer. His job becomes cultural, not technical. Protect the environment, protect the philosophy, protect the integrity of the machine. But this period also reveals the emotional cost running parallel to his professional ascent. The death of his son Paul years earlier is not an isolated tragedy. It's a long-lasting internal wound. As the firm grows stronger, his internal world grows quieter and heavier. People close to him notice a shift. The brilliance is still there, the curiosity is still there, but the lightness is gone. You cannot separate the man who built Renaissance from the man who lived through that grief. It changes his tone. It changes what he values. It accelerates his movement towards science and philanthropy. It pushes him to build something that outlasts markets. But before that new chapter begins, Renaissance hits another kind of crisis. Not mathematical this time, but legal. The IRS targets a trading tactic Renaissance uses to classify short-term gains as long-term capital gains. It becomes a congressional spectacle, Senate hearings, investigations, political theater. Simons is forced into a domain he hates, public scrutiny, and the way he handles it shows his operating philosophy again. He doesn't try to win the fight dramatically. He doesn't rage against regulators. He treats the problem like an equation. What is the solution that protects the machine? That solution ends up being one of the largest tax settlements in U.S. history. Expensive, yes, but survivable. Strategic retreat over ideological battle. Renaissance lives to fight another day. Then comes the cultural fracture inside the firm, the Mercer problem. One of the two minds who built the modern Medallion engine begins injecting his wealth and influence into aggressive political projects that Simons fundamentally disagrees with. It creates a split at the highest intellectual level of the organization. But Simons won't allow Renaissance to become a political institution. So he applies the same principle he applies everywhere. Separate noise from signal. He finds a way to gradually move Mercer away from leadership without
Simons
detonating
knows
the firm.
exactly what Renaissance is. A machine that will outlive him. The system evolves without him. The people are better than him at parts of the problem. The architecture is self-healing. The culture is self-correcting. And so he begins to pull back. Not because he's tired, but because the machine is ready. This is the breaking point between founder psychology and operator psychology. Most founders cannot let go. Simons can. Because the system, not the self, is the legacy. As the machine grows stronger and Medallion starts posting numbers that don't look real, something counterintuitive happens inside Renaissance. The internal volatility goes up, not down. Success doesn't calm the environment, it amplifies the eccentricity already baked into the culture. You have some of the smartest people in the world sitting in the same building, each with sharp egos, short patience, deep intellectual pride, and virtually no social calibration. They're not wired for diplomacy, they're wired for solving problems. And when you put that many high-variance minds in one place, friction becomes part of the operating environment. But Simons never tries to smooth that friction completely. He understands a truth most leaders never grasp. You don't get peak creativity from well-adjusted teams. You get it from people who are obsessive, unbalanced in specific ways, intolerant of mediocrity, and incapable of pretending they agree just to avoid conflict. Conflict is data. Conflict exposes weak assumptions. Conflict forces clarity. In a normal company, conflict is dysfunction. In Renaissance, conflict is part of the algorithm. Simons only intervenes when it threatens to degrade the quality of the work. Meanwhile, Medallion's returns are beginning to distort the psychology of everyone outside the building. Investors, journalists, competitors, none of them believe this level of consistency is possible without cheating, insider knowledge, or some hidden unfair mechanism. The industry tries to reverse engineer their success by projecting its own logic onto Renaissance. They must have a grand unifying theory of markets. They must have discovered one deep secret. They must be doing something magical. All of these assumptions reveal the same flaw. Wall Street thinks in terms of big ideas. Simons thinks in terms of thousands of small ones. That is the entire edge. There is no singular insight behind Medallion. There is no narrative anchor. There is no elegant principle. What Renaissance builds is an architecture where thousands of weak predictors combine into strong edges, something that looks impossible from the outside, because almost no one else is willing to manage that level of complexity. Other firms want simple explanations. Renaissance wants repeatable behavior. Other firms want conviction. Renaissance wants probability. Other firms want understanding. Renaissance wants predictive accuracy. As the system evolves, the firm becomes almost allergic to stories. Stories seduce you into thinking you know why something works. Renaissance doesn't want why. It wants numbers. It wants experiments. It wants constant revalidation. Every signal, no matter how long it has worked, is guilty until proven innocent again. That paranoia is not emotional. It is structural. A model that stops questioning itself decays, and a decaying model dies silently. At this stage, every major crisis in the outside world becomes a stress test for the internal philosophy. Markets crash, competitors collapse, volatility spikes, and yet Medallion keeps printing returns. Not because it's designed to predict macro events, it isn't, but because it is designed to adapt faster than humans can panic. When markets fall apart, Renaissance's systems are not trying to understand the chaos, they are measuring it statistically and acting accordingly. That's the difference between LTCM and Renaissance. LTCM had a theory about the world. Renaissance had a method for operating under uncertainty. Inside the firm, Simon's role shifts again. He no longer needs to be the intellectual center. Brown, Mercer, and Laufer have pushed the technical frontier far beyond him. He's still sharp. He still understands the ideas. But the machine now contains layers of statistical and computational complexity that only the new generation fully grasps. And Simons doesn't fight this. He doesn't need to be the smartest person in the room. He just needs to maintain the environment where the smartest people in the room can think clearly. This is a rare shift in founder psychology. Most founders cling to technical leadership long past the point where they're the bottleneck. Simons does the opposite. He steps back just enough to let the system grow. He transitions from innovator to steward, from architect to protector. His job becomes ensuring the culture remains brutally honest about what works and what doesn't. But the emotional arc of his life complicates this period. His professional success and personal grief exist side by side. The loss of his son Paul years earlier didn't disappear. It just got quieter. And as Renaissance's results accelerate, the contrast between external triumph and internal pain becomes sharper. People close to him notice a heaviness that never fully lifts. Simons becomes more contemplative, more aware of the randomness of life, in a way that mirrors his understanding of markets. Patterns exist, but so does noise. Some noise is manageable, some isn't. This emotional backdrop shapes his decision-making more than people realize. It drives him toward philanthropy, toward science, toward work that has nothing to do with financial return. The man who built the most successful trading engine in the history is slowly shifting his attention to problems that can't be solved by algorithms: autism, physics, biology, the origins of the universe. problems that require patience rather than profit, problems that echo the mathematical mindset he started with. But before he fully transitions out of the financial domain, Renaissance faces the political and cultural fracture created by Robert Mercer's ideological extremism. Mercer is one of the two minds who helped build Medallion's core. Removing him is not simple. Confronting him is not simple. But Simons cannot allow Renaissance to become a political weapon. The firm is designed to be ideologically neutral, a pure scientific institution operating inside finance. Mercer's political behavior threatens that neutrality. Simons handles the situation the only way he knows, analytically. He doesn't make it personal. He doesn't wage a public fight. He separates the signal from the noise. What is necessary to protect the institution? What stabilizes the machine? What preserves culture? That analysis leads to Mercer's gradual removal from leadership. The exit is quiet, deliberate, and strategically paced, exactly how Simons handles every decision that could destabilize the system. As the political drama fades, the financial machine keeps compounding. The returns reach a level where the firm has to close Medallion to outside investors entirely. The reason is simple. Too much capital dilutes edges. Renaissance is the rare institution that refuses to scale past its optimal range. Most hedge funds chase asset growth because fees increase. Renaissance does not. They chase precision. They chase persistence. They chase sustainability. No one else in the industry thinks this way. And that's the difference between a fund built for shareholders and a fund built as a
Simons
scientific
knows exactly
machine.
what Renaissance is. A system that no longer depends on him. That's not a loss. It's the goal. Most founders never reach that point. They build institutions that crumble when they leave. Simons builds one designed to outrun him. This is the highest form of founder discipline. It's the difference between a great operator and a great builder. The closer Simons gets to stepping away, the clearer the underlying architecture of his life becomes. He spent decades building a machine that interprets signal, and now he's directing his attention toward domains where signal is almost impossible to verify: mathematics, cosmology, biology, science at the frontier. The transition isn't random. It reflects the deepest pattern in his psychology. He was never motivated by markets. Markets were just the most efficient testing ground for his real obsession: the extraction of structure from chaos. The more complex the domain, the more cognitively alive he feels. Finance was a detour, a massively profitable detour, but a detour nonetheless. As returns compound, the machine begins behaving in a way that almost no financial institution ever has. It becomes self-funding, self-correcting, self-optimizing. The problem with most investment firms is simple. The capital dictates the strategy. Performance is secondary to scale. Renaissance reverses the logic. Strategy dictates capital. If adding more money reduces predictive power, they cut the money. Not because they want to, because that is what the machine demands. They treat the system with the same respect a physicist treats an equation. You don't bend the equation to your will, you follow it. This is founder discipline at the highest level, the willingness to protect the integrity of the system, even at the cost of revenue. Most firms preach this. Renaissance practices it. Outside the firm, myths multiply. People call Simons the man who solved the market. But the phrase is misleading. He didn't solve anything. He built a structure that adapts faster and more accurately than any human theory. That's the point. Markets cannot be solved. They can only be modeled probabilistically with enough granularity that the residual randomness doesn't break the machine. That's what Renaissance accomplished. They built a statistical engine that never stops recalibrating. Inside the firm, the people who understand the system best, Brown, Mercer, Laufer, the senior researchers, know exactly how fragile it all is. They understand that every edge decays, every signal loses power, every predictor becomes noise eventually. That's why the culture never relaxes. You could argue that Renaissance's highest accomplishment is not the returns themselves, but the refusal to let returns create complacency. In any other environment, success this extreme would destroy operational discipline. Here, it becomes fuel. The more they win, the more paranoid they get. It's the correct paranoia, the kind that extends longevity. This paranoia reaches its peak when the political fallout from Mercer's activities hits full scale. Renaissance becomes collateral damage for a conflict that has nothing to do with markets. Senate hearings, public scrutiny, internal tension, the machine is suddenly surrounded by noise, and Simons has to make one of the hardest decisions of his career: confront the person who built half the engine. But he doesn't do it emotionally, he does it structurally. What preserves the institution? What minimizes risk? What removes instability without triggering collapse? The answer is surgical removal. Phased, quiet, controlled. This is the difference between a founder driven by ego and a founder driven by system integrity. Simons will sacrifice anything except the machine. As he moves toward retirement, his attention shifts almost fully to the scientific world. The Simons Foundation becomes the next version of Renaissance, not because it resembles a hedge fund, but because it resembles a search engine for truth. He pours money into math, physics, autism research, computational biology, genome mapping. These aren't random philanthropic gestures. They're extensions of the same internal operating system that drove him for decades: the belief that complex systems yield to persistent inquiry. Renaissance was proof of concept. The foundation is the final application. When he finally steps back from the day-to-day, the machine continues without him. This is the final marker of a great founder. Most institutions collapse when the founder leaves because the founder was the institution. Simons built something different, a decentralized intelligence network where no individual, including himself, is indispensable. The algorithms can evolve without him. The culture can sustain itself. The infrastructure can scale independently. The next generation can push the frontier without waiting for his approval. This didn't happen by accident. It happened because Simons operated according to a set of principles that almost no founder manages to maintain. Never mistake intuition for truth. Never let ego outrank data. Never allow success to validate complacency. Never allow narrative to contaminate empirical clarity. Never allow culture to drift into comfort. Never allow hierarchy to silence accuracy. These principles are the actual edge. The math matters, the modeling matters, the infrastructure matters, but the cultural philosophy beneath all of it is what makes Renaissance impossible to replicate. You could hire the same PhDs, you could buy the same hardware, you could scrape the same data, but you can't copy the mentality. You can't reproduce decades of institutionalized skepticism. You can't fake the discipline required to let the machine outrank the founder. This is why Renaissance stands alone. Not because it solved the market, but because it built a framework where solving the market wasn't the goal. Understanding structure was. And when you pursue structure relentlessly enough, the world eventually pays you for it. Simons' final arc closes the loop. The man who started with no interest in money, who just wanted hard problems, ends up building the most profitable trading engine in existence, and eventually he walks away from it. Not because he's done, but because he's returning to the original pursuit, the clean pursuit, the one he started with before finance intervened, the pursuit of truth in systems too complex for most people to endure. Renaissance is the artifact of that pursuit. The returns are the side effect. The machine is the legacy.